Hey, hi everyone. Welcome to another video in our option selling positional trading adjustments series. So today we are going to discuss about adjustments that could be done for synthetic long positional trade in the Indian index markets. We will go through some scenarios and examples from Nifty, Sensex, and Bank Nifty for each adjustment that could be done. So synthetic long is one of the most important positional strategies used in the Indian options market in Nifty, Sensex, and Bank Nifty. Okay, so what is a synthetic long? Synthetic long replicates the payoff of a long futures position. Okay, so it's similar to a long futures, but what is done here is in a synthetic long is you buy a ATM call. So you're buying a ATM call and you're selling an ATM put. So our view is in this particular case that it's a long view. So you have a bullish view here because you will make money if market goes up from the call as well as the put also. It's the same strike, same expiry. So same strike, same expiry. You will choose of the ATM call that is bought as well as the ATM put that is sold. Payoff is similar to futures. Unlimited profit is there on the upside and limited loss is there on the downside. Margin required is similar to futures since short put margin is high. For adjustment scenarios, yeah, so you have a bullish view, but what happened is market has fallen sharply. So the big down move is there. So Nifty was at 20. Example is Nifty was at 20,000 spot, and it fell to 19,500. A 500 point movement, sharp down movement is there. So long call will lose value, and short put also heavy loss will be there. So net would be a big downside loss will be there. So adjustments that we could do is we can add a protective put hedge. Okay, so we can buy a PE, lower strike PE, example 19500 PE to limit loss. Okay, so one is buying a lower strike PE which acts as a protective put. Second one is converted into bull call spread. So you sell higher strike CE against your long CE to reduce cost. Okay, so convert into a bull call spread also could be done. Okay, or if you feel that the bearish view, so now the market is has become bearish and your bullish view was wrong, square off the particular trade and cut the losses. Okay, the other adjustment you could do is shift it to next expiry. So you could roll the short put which you have done to next month, which will reduce you the market to market pressure. Okay, market rises moderately, so this is the best case. So Nifty has moved from, for example, from 20,000 to 20,300. Long call will gain because it's a bullish moment, and short put also will expire worthless. So net will be profit. So you book your profit square off when you capture 50 to 70% of expected gains. Okay, or you could do that's the best thing to do, booking the profits okay early. Second thing you could do is convert to a covered call. So sell a higher CE to lock profits and reduce risk. So like 20,500 CE you could sell to lock profit and reduce risk. Or you could roll the short put up. So you have shorted the put, right? So this 20,000 PE you have shorted, move it to 20,200 because market has moved to 20,300 now. This will collect more premium and lock in the gains. Yeah. The third scenario is market has fallen sharply. So when market has as a windfall rally like on the upside, it rises sharply. So for example, Nifty is to 20,000, it moved to 20,800, 800 point jump. So long call will have huge profit. Short put also will expire worthless. So net would be windfall gain in this particular scenario. Okay, so you just book the profits and take the profits. That's the first thing you need to do. Or adjustment wise, there is no adjustment needed because you'll make a lot of money. But if you want to do, you can do these adjustments. So sell OTMC. So book some profit by selling this 2100 CE, which you have, yeah, some OTMC you can sell 21,000 C, which converts into a bull call spread. Okay, or you can roll up the short put up. So you shorted the 20,000 PE, right? You can now move it to 20,500 or 600 PE, which will, more credit is there at lower risk. Yeah. Trail stop loss on call. You can trail the stop loss on call, which protects profit in case of reversal. Okay. Market is sideways range bound. If it is between Nifty is between 9950 and 20,050, long calls will have a theta decay because it is sideways. Short put will earn the theta. Net it will be if short put theta is more than long call loss of theta, it will be gain or else it will be loss. Okay. In this case, if the market is range bound, you can add another short CE. Okay, which will convert it into short straddle. So 20,000 CE plus 20,000 PE, and it will make profits in a range bound market. Or you could convert it into triangle. You could short a PE, OTM, and sell a OTM CE. Uh, okay, so that you make money in the sideways market. If you know the premiums are eroding and theta decay of the call is more than the put, you can exit the trade also. Volatility spikes, short put premium will rise because of volatility, VIX rising. Okay, so that's a risk because you've sold that put. Long call premium also will rise, which is good, but that benefit won't offset the short put risk we have. So Vega risk is negative here because of the short put. In this case, you buy a protective put. OTM offsets Vega risk. So OTM put we can buy to offset the uh, Vega risk. Or you could convert into a collar, keep synthetic long as it is, add a for OTM PE. Okay, in case of volatility spike, or shift put to lower strike, roll down the PE for less Vega explosion. Expiry week gamma risk is very high. Every small move can cause big NTM swings. So you square up the position, short put early. Don't carry naked short puts near expiry. Okay, convert into a vertical spread, sell higher C, lock profit and reduce margin. Roll forward, shift to synthetic lock to next expiry. View remains bullish. So that's the synthetic long guys. Adjustment playbook in summary is big fall is there. Okay, you buy a hedge by buying a PE, and or you convert into a bull put spread and or exit early if your view is bearish. Uh, Now, moderate rise is there. You book the profits. Okay, or and you can roll up the PE, or you convert into a covered call. Big rally is there. You book the profits here also, and you can sell OTMCE and roll PE higher also in this case. Sideways, sell extra CE, convert into a straddle or a triangle. VIX spike is there, convert into a collar or buy OTMPA. If expiry week, close the PE position, the short position, convert into a spread or a roll forward. So that's the synthetic long adjustments, guys. Thanks everyone. Have a nice day. Bye.